Our next guest says we are in the golden age of fixed income, but as a conflict in the Middle East raises inflation fears and investors look outside of government debt markets for safe haven value, is that window of opportunity getting smaller? Let's go to Rick Rieder, CIO of Global Fixed Income at BlackRock. Rick, thanks for joining us today.
Thanks for having me on. I appreciate it.
There's so much going on, but what does that window look like right now?
So well, you say so much going on, the volatility every day, the news flow every day. I was thinking, I woke up last night in the middle of the night watching these markets moving around, and then I kept waking up, and you realize we're going to live in this period of volatility, of uncertainty, what have you. I think that window is still there around getting yield. I mean, by the way, you look at today, I mean, look at where 10-year treasuries are in the U.S., and they haven't really moved literally over the last couple of years, with some variability. We keep coming back to around the same place. The window of opportunity is around where you create income. And that income, whether it's using things like the credit markets, the real estate market, the mortgage markets, et cetera. So I think there's, as long as you believe, which I do, that inflation over the intermediate term is 2.5 to 3 and maybe coming lower than that, I think it's a great time to get yield and income in the portfolio. I just think you have to be balanced in how you get it, and you have, quite frankly, oftentimes you got to extend the lens a bit and say, I can't watch every day because the volatility's high, but income will do its job.
Okay, you heard the American president now saying the conflict is pretty much over, or close to being over. Does that alleviate any overarching concerns about inflation?
It's helpful, but it's helpful to the extent that it's hard interpreting what that means and how to think through what is the T+1. Listen, if today, where oil prices, I mean, the spiky nature of it, like you saw last night, is something that the market's going to have some concern around for interest rates, for fixed income generally. To the extent that we are on the backside of that volatility, yeah, that would be a comforting thing to witness.
Okay, let's talk about fixed income outside of North America. Where are you looking these days?
So, I mean, one of the great, we've had this period of time where the dollar has been restrained, other than this period where the dollar rallied. I actually like emerging market debt. You've got to be a little bit careful around today. We've reduced some of the exposure a little bit, but you look at today, the income we get in places around the world in emerging markets. So parts of Asia, parts of, quite frankly, Latin America, places like Mexico and Brazil, where the yields are extremely high. Again, we got to be careful in the near term around currency, but looking for getting your yield into the portfolio in the emerging markets is a place we like quite a bit. Owning credit in places like Europe has been fantastic for a couple of years. Today, the spreads have gotten a little bit tighter, but we still like things like the securitization market in Europe and including places like Australia. So we're looking for where we can go in the securitization market around the world, getting more developed in places like Europe and Australia. And so those are opportunities we're looking at. Okay, so
in emerging markets, is there one that you like over others? And would you jump in now, or is it something you're just watching?
So I like Mexico. I mean, I like front end yields in Mexico. I think ultimately inflation will come down. It's certainly more stable, and from a political point of view than many of the places we look at. And not only on the government debt, you can also buy corporate debt in Mexico. So I like Mexico. That being said, being a little bit patient today, given the volatility in terms of how you increase your exposure. But listen, I will say one thing for investing for a long time. We're going to go through these periods where you get these bumps in a round of volatility. I think like everything we do, and same thing with equities, is you buy a bit today, you see where we are, and you're patient, and you add to it on more pressure over the coming weeks if you get it.
Where are you landing these days on a rate cut in the U.S.? How much of it depends on the length of the conflict in the Middle East?
So, I mean, I think the Fed's going to cut this year. I think they're going to try and cut a couple of times. I think clearly when you've got higher inflation prospects, do they sit on hold for a longer period of time? I think you have to respect that. And I think the markets have priced that. That being said, I mean, it's very important when you think about what causes inflation. When you have a demand-driven level of inflation, that's very different for the Fed than it is when you have a supply shock. Because what a supply shock does is it actually transmits a slower growth paradigm. It definitely brings down consumption. It brings down growth. I still think it leaves the window open for the Fed to cut. I just think you extend out a bit longer because people will look at that inflation to see how much is supply versus demand driven. But gosh, if there was a supply shock like this is, then I think you can still cut. In fact, I think you should cut because of the pressure it puts on, particularly lower income, small businesses, that I think actually enforces that you should cut. Do they wait a bit longer? Yes, I think so.
Okay, so factor in, and again, this goes to the whipsaw nature of what we've been seeing. Factor in the jobs numbers, right? 92,000 lost. That was unexpected for the most part. Factor that in to what you're thinking for the central bank.
So, I mean, there are certain things that are, in markets that are ambiguous. Your question about what does it mean in terms of the conflict and how close are we, those things are very hard. And as much AI and other tools that you have to figure it out, they're hard. Figuring out that we have a decline in employment is not that hard to figure out. When you strip out healthcare jobs, we've had for the last 9 months negative 358,000 jobs with an economy that's running over 5% growth. That is not ambiguous. We have a job problem that I think longer term, when you think this is pre-AI, most of what's coming in AI, pre-robotics, pre-automation, or the real impact of those dynamics. So I think, and part of why I think the calculus of rate cuts should be there, is we have, with an economy that's really doing well, we're not hiring people away from healthcare. Healthcare is demographic driven. We have an aging population. It's not cyclical, but I think it's quite real that we're just not employing enough people. And I think moving rates, being helpful from a rate perspective, that's the big one. It's different in the ECB when their sole mandate is inflation. When your mandate is maximum employment and price stability, that employment dynamic, we're certainly not anywhere close to maximum employment when you have that sort of job loss.
Rick Rieder, I got to leave it there, sir. I'm out of time. Appreciate your time. Thank you so much for joining us.
Thanks for having me. Thank you.